A truck driver was paying $2,500 per month on a carrier lease. He went to go see my colleague Josh back when Josh worked at a credit union as a loan officer. And the driver asked if there was a better deal available somehow for his truck. A few months later, he was paying only $555 per month. The same truck, the same driver, but almost $2,000 more in the driver's pocket each month. In this video, I'll show you exactly how that happened. My name is Dan Domino. I run a consulting company called J Street Group, and we help owner-operator truckers and other small business owners get financing. Josh is one of the people on my team. He spent years as a commercial lender at a credit union, reviewing loan applications and underwriting deals and working with a lot of self-employed business owners, including truck drivers. Now he's a CFO and a consultant on our team. A few days ago, I asked him to walk me through an owner-operator lease buyout situation from his days as a lender. And this is a situation he told me about. The driver in this case was leasing his truck through Swift Trucking. It was a lease purchase agreement. He'd been driving for several years. He had a solid record and relatively steady income. His monthly truck lease payment was $2,500. That truck had about 600,000 miles on it, so it was a well-used truck, but still a working asset and still generating income every week. The market value of that truck at the time was around $60,000. His buyout amount, so the amount he'd need to pay Swift to settle up the lease and get the truck title in his name, was $50,000. So first I'd like to make a note of those numbers. So a $60,000 market value and a $50,000 buyout price leaves a $10,000 gap. And that gap was the driver's equity in the truck. The truck was worth $10,000 more than what he owed to own it outright. This driver wasn't fully aware of what that meant for his financing when he walked in to speak with Josh. But that $10,000 turned out to be a key reason why his loan got approved, and we'll come back and talk about that a bit more later. So one thing that's worth saying here in this guy's situation, this driver wasn't in a bad spot. He wasn't behind, he wasn't desperate. He came in to talk to Josh because he figured it couldn't hurt to ask if there were better options available for him. And that's actually how a lot of these conversations start, with a driver that has a feeling that maybe there's a better way, and they just start asking questions until they find out what their real options are. Unfortunately though, a lot of people never ask that question. They don't actually find out whether there's a better way to finance their truck. Okay, so as Josh and this driver talked through his situation, it became clear that the best type of financing in this driver's case would be an SBA loan, specifically what's called an SBA 7A loan. Now, a lot of owner-operators we talk to assume that SBA loans aren't available to them. A lot of people assume that SBA loans are more for restaurants or retail businesses, things like that, but not for owner-operator truckers. But SBA loans can be used for trucking. They won't work for every driver situation, and we'll talk about other options you have if an SBA loan doesn't work, but SBA loans are used more often than most people realize to finance tractor trailers. So here's how that works. The SBA, the U.S. Small Business Administration, doesn't lend money directly to borrowers. What it does is guarantee a portion of a loan that a bank or other lender is lending to a borrower. And if the borrower defaults, the SBA covers part of that lender's loss. And that guarantee matters a lot for self-employed truckers because it allows lenders to be more flexible in their criteria when they review a trucker's application. Owner-operator's income looks different from most other types of businesses that apply for a business loan. So your income might come through settlements or 1099s or Schedule Cs. A traditional bank, so without the SBA's involvement, gets really cautious when they see that type of income because it's not straightforward. And that complexity in their eyes means extra risk for them or perhaps extra effort. But when the SBA is involved, when it's an SBA loan, their involvement in the loan allows the lender to be more flexible. They'll be more willing and more able to dig into your real financial picture and understand how your revenue and how your expenses and how your cash flow really works as a trucker. So that's one of the reasons why an SBA loan made sense here in this case. Okay, so here were the numbers. A $50,000 buyout at 6% interest at that time and a 10-year term brought the monthly payment to just $555. The carrier lease payment had been $2,500 a month. So in terms of monthly cash flow, the savings each month was $1,945, which adds up to an annual savings of just over $23,000. So let's look at what made this possible. What allowed Josh and that driver to reduce the monthly payment so much? Because it wasn't just the interest rate. The main thing was the length of the loan. SBA 7A equipment loans can be structured to be as long as 10 years. And that 10-year window is what enabled a $50,000 loan to have a $555 monthly payment. And in contrast, the carrier lease wasn't structured in a way to make it affordable. That's just not what that carrier lease was designed to do. Now, this loan was made several years back, which is why the interest rate was 6%. But as I'll show you in a second, even at much higher rates. Most lenders, whether they're banks or credit unions or specialty equipment lenders, they're usually able to beat carrier leases in terms of monthly payment affordability. Again, because the carriers aren't incentivized to make their leases affordable. That's just not the goal they're aiming for. Now, there's an important question I want to address at this point, which is, what if someone can't qualify for SBA financing? Maybe the credit score isn't quite what it needs to be, or the income documentation is extra complicated. Whatever the reason, what happens then? Here's a comparison that Josh and I put together to answer that question. So for this same driver with the same truck and the same $50,000 lease buyout, here are his other options. So here's that carrier lease. That payment was $2,500 a month. That's a starting point that we're comparing the other options to. Next is the SBA loan at 6% interest with a 10-year term. So paying the truck off in 10 years. That's the $555 a month payment. And as we mentioned, his savings compared to the carrier lease was just under $2,000 a month. Next is private equipment financing. This is specialty equipment financing from a non-SBA funding source at 20% interest, so at a very high interest rate with a 10-year term. And that monthly payment is $966. So the savings here versus the carrier lease is about $1,500 per month. Here's another option. So that same 20% interest rate, but a shorter term, paying off the truck in 5 years instead of 10. So as you'd expect, because of the shorter term, it has a higher payment. So it's $1,325 per month, but it's still a significant savings versus the carrier lease. He'd still be saving $1,175 per month. So if you look at this bottom row, the toughest financing option here on the table, a 20% interest rate with a shorter term still saves a driver about $1,200 a month compared to the carrier lease. And if you add that up over the course of a year, that's still $14,000 per year in savings versus the carrier lease. Now, I'm not necessarily recommending a 20% interest rate on a truck loan. Now, that's a high rate, to be clear, but what I am pointing out is the range of options and how they all beat the carrier lease when it comes to the monthly payment, even the option with the highest interest rate. So the best path on this table saves a driver just shy of $2,000 a month. The worst path still saves him roughly $1,200 a month, and every option has a lower payment than the carrier lease. Those carrier lease programs are priced the way they are in part because a lot of drivers in a carrier lease don't go through the full process of shopping around for a better deal. That comparison just doesn't get made, so the carriers feel like there's no reason for them to change their lease pricing. So going back to this driver, Josh's client, when Josh showed him the SBA payment, $555 per month, the driver's reaction was like, well, why didn't anyone tell me this was possible? And the honest answer is no one was going to tell him that unless he went and searched around to find it out himself. The carrier's leasing department is right there when you need a truck. The application is right in front of you, and it's a fairly easy way to get on the road quickly. There's no moment in the process where someone would sit down with you with a comparison table and say, well, here's what the bank or equipment lender would charge for that same vehicle. That's just not how it works. Okay, so let's talk about what it actually took for this guy to get his loan. The SBA is not a quick process. SBA loans require more paperwork than other types of loans, and there's one part of the specific deal because it was a lease buyout that took longer than expected. For an SBA loan for a tractor trailer, here's what you'll generally need to provide along with your loan application. 2 years of personal tax returns, 2 years of business tax returns for Schedule C's as a driver, a current year-to-date profit and loss statement, a personal financial statement that shows what assets you own personally, like a car or a house, etc., and what your liabilities or your debts are. 3 to 6 months worth of bank statements and a written payoff document from the carrier. So in this driver's case, Josh needed those documents from him. And for a driver who's out on the road, gathering all that stuff takes some time and effort. This driver did it. It wasn't convenient, but he got it done. And if you find this part especially hard, I'd suggest you get in touch with an accountant. They'll be able to help you put together the documents you need. And of course, feel free to reach out to us as well, and we can help point you in the right direction. Now, in this driver's case, and for a lot of lease buyouts, the slow part was the title. So this guy's truck was titled under Swift as part of that lease agreement, and before the loan could get funded, the title had to be released. So Swift had to confirm the exact payoff amount, and the title had to transfer to the driver. That required some coordination between Josh's credit union and the driver and Swift's fleet financing department, and it was a bit of a process. There were follow-ups and document requests going in both directions and calls that took a little while to get returned. Josh and the driver had to keep pushing people to get the deal done. There were some points where it felt like things could stall, but ultimately they pushed through and got the deal done. The total time it took from the first conversation Josh and the driver had to a funded loan was between 2 and 3 months. That's not fast, but if you're saving roughly $2,000 each month, every month you wait costs you $2,000. So if you're a driver in this situation and you look into your options and find that you can refinance out of your lease, if you're hesitant because of the time and effort required, that's something you'll need to weigh in your mind. But once you decide to do it, the sooner you start the clock on that whole process, the less money, of course, you'll spend on those higher lease payments. So here's how it ended for this driver. The loan got funded. Josh's credit union sent the $50,000 payoff to Swift. Swift released the title. It transferred the driver, and his new monthly payment was $555. And in this driver's case, he kept on driving for Swift. He continued to have a solid relationship with that carrier. What did change, though, was that carrier no longer had a financial claim on his truck. Before the loan refinancing, Swift held the title. The truck legally and financially was under their control as part of the lease agreement. And the driver, to a very real extent, was under the carrier's control as well. After he got the loan and refinanced the truck, the driver had a new amount of freedom. He owned the truck. He could stay with Swift if he wanted to, or he'd take the truck somewhere else eventually if he thought that made sense. He wasn't trying to escape Swift. That wasn't the point, but he did want to stop being financially dependent on them so much and have the ability to make the right moves for himself long term. So in this driver's case, yes, his lease refinancing brought him about $2,000 a month in savings, but it also brought him a much different outlook on driving because now he felt much more in control. So if you're going to carry your lease right now, and if you've been wondering whether the financing deal you have on your truck is the best deal available, I'd encourage you to at least find out the answer to that question. If you need help, feel free to reach out to Josh and I in the comments or by email. Our email address is down below, and we'd be happy to give you some guidance, and you can learn more about us in the link in our bio. We'll be posting a lot more videos on this exact topic, how to get financing that actually works for you as an owner-operator trucker. So subscribe to see those as they come out. Thanks for watching, and we'll see you in the next video.